your key to the market. We're talking stock options today. Stock options are special contracts giving you the but not the to buy or sell a stock. Think of it like putting a deposit down on a car. You reserve the right to buy it at a certain price. You don't to buy it if you change your mind, but the dealer has to sell it to you if you decide to go for it. That's power, people. There are two main types of options: call options and put options. Call options are for the bulls. You think a stock is going up? Calls might be your ticket. Put options are for when you think a stock might be heading south. Key terms: strike price, fixed price to buy sell, expiration date, shelf life, and premium, cost of the option. Why bother with options? One word: leverage. Control a whole bunch of shares for a fraction of the cost. Imagine controlling $10,000 worth of stock for just a few $100. That's serious power. It means your potential profits can be magnified. Of course, magnification can work both ways, and we'll talk about risks. But the allure of controlling more with less capital is a huge reason people dive into options. Let's talk call options. If you're bullish and believe a stock is ready to blast off, call options are your friend. A call option gives you the chance to profit from an upward move without buying all the shares up front. When you buy a call option, you purchase to a specific stock at a pre-agreed price, strike price, by a specific date, expiration date. For this right, you pay a premium. If the stock price climbs above your strike price before expiration, you're in the money. You can exercise your option or sell it for a profit. Example: Tech Giant Inc. (TGI) stock is trading at $150 per share. You think it's going to $170 soon? You buy a call option with a strike price of $160, expiring in 3 months, for a $5 premium per share. If TGI stock shoots up to $175 before expiration, your option is golden. You can exercise it, buy at $160 and sell at $175, making a profit. If TGI stock doesn't go up, your call option will expire worthless, and you lose the premium. Your loss is capped at the premium you paid. This limited risk is a big deal for many traders. Now let's talk about put options. If you think a stock is overvalued and due for a tumble, or you want to protect your profits, put options are your tool. Puts are for those who anticipate a stock price decline or want to hedge their positions. When you buy a put option, you purchase to a specific stock at a pre-agreed price, strike price, by a specific date, expiration date. You pay a premium for this right. If the stock price drops below your strike price before expiration, your put option becomes valuable. Example: Old Reliable Corp. (ORC) is trading at $50 per share. You think it's going down. You buy a put option with a strike price of $45, expiring in 2 months, for a $2 premium per share. If ORC stock plummets to $35 before expiration, your put option is a winner. You can sell at $45, making a profit. If ORC stock doesn't fall, your put option will expire worthless and you lose the premium. Your maximum loss is limited to the premium. Why bother with options? Unlocking the awesome upsides. Options offer lower upfront costs, flexibility, and leverage. To buy 100 shares of a stock trading at $200 per share, you'd need $20,000. But an option contract controlling those same shares might only cost a few $100s. Options offer incredible versatility. You can craft strategies to profit if a stock goes up, down, or stays flat. You can hedge your portfolio, generate income, and more. Leverage allows you to control a large asset with a small amount of capital. A modest stock move can translate into a much larger percentage gain on your option premium. But leverage can magnify losses too, so respect it. You can also sell options to collect premiums. Selling covered calls is a popular strategy. Lower cost, flexibility, leverage, income. These are serious reasons to get excited about options. Hold your horses. The real risks of riding the options wave. Options trading isn't all sunshine and rainbows. The number one risk is losing your entire investment in the option. If the stock doesn't move as predicted by the expiration date, the option can expire worthless. Time decay, theta, is another risk. Options lose value over time. Complexity is a major hurdle. Options have many moving parts. If you don't understand them, you're just gambling. Selling options, especially naked calls or puts, can face potentially unlimited risk. If you sell a naked call and the stock skyrockets, your losses can be astronomical. Beginners should avoid selling naked options. Stick to buying options where your risk is limited to the premium paid. Learn safe selling strategies like covered calls. This is serious business. Playing it smart. A simple strategy and your first steps to options victory. One popular and conservative strategy for beginners is the covered call. If you own at least 100 shares of a stock, you can sell a call option against those shares. This is covered because if the option gets exercised, you already own the shares to deliver. You sell one call option contract with a strike price higher than the current stock price. For selling this option, you receive a premium. If the stock price stays below the strike price by expiration, the option expires worthless. You keep the premium and still own your shares. If the stock price rises above the strike price, the call option will likely be exercised. You'll sell your shares at the strike price, making a profit and keep the premium. The main risk is missing out on potential gains if the stock skyrockets. To get started, educate yourself, paper trade and start small. Learn, practice, and then go make some money.